So how are you this evening? Ready to discuss capital budgeting? Or you have some questions with respect to the previous classes as well? I'm also good, thank you, Ruchika. Just 1 second. Okay. So here we are. In the last class we started with capital budgeting and I gave you the conceptual framework. I said that capital budgeting is a technique which is required, which we utilize in order to analyze the investment decisions. I hope you remember this. I also discussed with you that in this particular technique we have an uncertainty associated with it because we're talking about the future, and future is always uncertain. But the idea is, because these investment decisions are very, very important for any business, they are the decisions which may make or break a particular business. This is one decision which can add maximum to the shareholders' wealth, and that is why this decision is considered to be a very, very important decision. Another reason for considering this decision to be most important is that because we've got limited funds and we have to do the right allocation of these funds. Right? And that is why again this decision is considered to be a very, very important decision. So I hope you remember that basic structure that I gave to you. I also told you that this is a decision where major amount of money is involved. It's a huge investment which has to go in the capital budgeting decision, and therefore again we have to be very, very careful about these decisions. Now before I go further in this particular aspect of capital budgeting decision, I must tell you that this is a very important chapter for examination. In general, minimum 10 to 15 marks question paper comes from this particular topic, and therefore you have to understand it quite in depth. Like you have to understand each and every aspect of this kind of a decision, and you have to be very well versed. Another reason is that in this particular chapter, whatever techniques you're going to learn, these techniques are going to be used throughout your syllabus. And that is also one of the reasons why you need to be, understanding this chapter very, 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 very particularly. And you have to do a lot of practical questions also from this chapter. So when we talk about capital budgeting decisions, you can take these decisions from two perspectives. One is the basic accounting perspective. That is like, as we have been doing so far in accountancy, what we say that in a particular project, we compare two projects from the point of view of return on investment or return on capital employed, or we look at the return on assets to analyze whether a particular project is successful or not, or is profitable or not, right? So you have been using the concepts of accounting so far. Many a times you might have calculated the return on investment, which is earnings from operations divided by the average investment in a particular business. You must have calculated the return on assets, where you look at the earnings from operations divided by the total assets of a particular business and compare it with some other business, and then you try to find out which particular business is more profitable. That is a technique that we use in accounting. But when we talk about financial management and we have to do a capital expenditure decision, there the technique that we generally recommend is the cash flow technique. Here we just look at the cash flows coming from a business. Like in case of accounting, you are looking at earnings from operations, right? So you can call it as earnings before interest and taxes as well. Now there is a basic deviation that you will see in when you analyze a profit and loss account from the perspective of financial management, and when you analyze a profit and loss account from the perspective of costing, or when you analyze a profit and loss account from the perspective of accounting. Now I'll tell you how. In case of accounting, when you make a profit and loss account, what do you write? you write sales, right? On the if you're making it in a vertical form, let us say this is your accounting profit and loss account, right? So what do you write first? Sales. Then from the sales you reduce the cost of goods sold, and when you reduce cost of goods sold from sales, what you get is the gross profit, right? And from this gross profit you reduce the indirect expenses. What are these? You reduce the administrative expenses, you reduce the selling expenses, you reduce the general expenses, and you reduce the financial expenses. And what do you get? You get the net profit, or you get profit before tax. In general, in accounting, rather you reduce the taxes as well, and you simply get the net profit after taxes, right? This is the format that you use in accountancy. If you have to make the similar format, if you have to do the analysis from the perspective of costing, then you will not use this format, because in accounting what you are more interested in looking forward to, or for the purpose of calculating or analyzing an accounting profit and loss account, the ratio analysis that you use, where you use the ratios of return on investment, return on capital employed, and all those ratios can be very well calculated from this particular format. When you make a statement from the perspective of costing, what you write? You write sales minus variable cost. What do you get? Is equals to contribution. I hope you're familiar with these concepts. From this contribution, you reduce the fixed expenses, right? And what do you get? You get the net profit. This is the format that you use. This is the format that you use in case of costing, right? When you are making the similar format from the perspective of financial management, here what you will do? You will start with, you will not start with sales minus working capital or sales minus cost of goods sold, or you can do that as well. So you can do it like that: sales minus cost of goods sold is equals to earnings before interest and taxes. No, sales minus cost of goods sold minus selling, administrative, general expenses. So these are called operating expenses here. Gives you earnings before interest and taxes. From this you reduce interest, then you get earnings before taxes. From this you reduce taxes, and what you get is profit after taxes. So, and from this you reduce preference dividend, and then you get earnings available for equity shareholders, right? So for 3 different subjects, you are using the same information but in different ways, because you have to do different kind of analysis. Is the point getting clear? Same information being presented in different manners from the perspective of different subjects. Okay. Now, because right now I am comparing between the accounting concepts and the financial management concept. So in accounting I use this information and find out the ratios. In financial management I am more interested in cash flows. So how do I find out cash flows? In order to find out cash flows, in this earning before interest and taxes, I will have to add the non-cash expenses. So how do I find out the cash flows? In order to find out cash flows, what I should do, not only in earnings before interest and taxes, rather in the profit after taxes, what I should do, I should add back the non-cash expenses. And in most of the cases in financial management, I generally take the figure of earnings before interest and taxes. Why? Because I have these, the level of interest is in my choice, because I am, as a person in finance, I am the one who has to decide with which how much of debt I have to take in my company. So I have no control over EBIT. As a manager in finance, I have no control over sales. I have no control over cost of goods sold. I have no control over operating expenses also to a very great extent. I can talk about, or I can recommend about reduction in some of the fixed expenses, definitely yes, but to a very great extent, I have no control over the operating expenses as well. So my analysis as a manager of finance starts from EBIT. And in order to calculate this EBIT, what I do, I add back the non-cash expenses. In order to find out cash flows, what I do, I add back in general non-cash expenses to EBIT figure, earning before interest and taxes. So what do I get? I get the cash flows coming from a business. And what are these non-cash expenses? Non-cash expenses are generally depreciation. Why depreciation is a non-cash expense? Because I do not pay this depreciation to anybody. And it is not a cash outflow going from my business. This is the amount, this is the provision that I create for depreciation. I just create a reserve out of it and keep this money with myself. So as a person of finance, I would say that if this money is with me, it is a source of funds for me. If depreciation is still there with me, that means I'm not supposed to give it to anybody. This is also a source of funds for me and I will utilize it in my way. That is why, as a person of finance, I am interested not in the accounting profits. I am interested in the cash flows. Is the point getting clear? The difference of the three subjects is clear? Right? So, now you've got, when you analyze a capital budgeting decision as well, you have got two techniques to look into. Should I look at the accounting profit or should I look at the cash flow technique? Is the technique which I am going to use in the financial management decision. So in cash flow technique, what I do, I find out the post-tax profit, that is a net profit after tax, before non-cash items, and I will add back non-cash items to it, like depreciation or any kind of amortization that you have done. So that will be added back. In general, the major adjustment is of depreciation only. Now the question comes, why is the cash flow technique better? And why, as a manager of finance, I'm more interested in the cash flow technique rather than using the accounting profits? There are two reasons for this. One is that in the accounting technique, there is a possibility of a lot of ambiguity, because how much of depreciation I charge, it completely depends upon the method of depreciation that I decide to use. And I can even change the method of depreciation. Isn't it? I can even change the method of depreciation. So therefore, there can be some ambiguity if I use the accounting technique. And in order to avoid that ambiguity, I'm using the cash flow technique. Secondly, by using the cash flow technique, I can consider time value of money. Now, what is this time value of money? This is the concept which I would be discussing with you today, just 2-3 minutes after this particular point. So under this cash flow technique, we would be using various methods. Some would be based upon time value of money concept, and some would be simply based upon the cash flow technique. So what is this time value of money? What is this time value of money? Just try to understand that if I have to make a payment to you of, say, rupees 1,000, and I say that I would be making you this payment after 1 year, will this 1,000 rupees which I would be getting after 1 year be equal to 1,000 rupees today? The answer is no. You would say that if you give me this money today, I will keep it in my bank account, or I will create an FDR out of it, and I would be able to earn some return on it. So if I give you this 1,000 rupees, What you will get after 1 year? You would get 1000 multiplied by 1 plus R. Now if this R is 10%, in that situation you would be getting 1100 rupees after 1 year, right? So you would tell me that, ma'am, if you have to make a payment to me after 1 year, you better pay me 1100 rupees rather than paying me 1000 rupees. Isn't it? Isn't it? So what are we trying to say? We are trying to say that 1000 rupees today is equals to 1100 divided by 1 plus R. Isn't it? So if you give me 1100 today, 1100 after 1 year, it would be equal to 1000 which I received today. Are you getting my point? Are you getting my point? No, yes. Okay, you're getting it. So what am I trying to say? I am saying that when in class 7, 8 you must have done this simple interest technique, there you would have said that what you have done, you are compounding the principal and the interest. You are using a compounding formula. When you use this formula, principal multiplied by 1 plus R raised to power n, where n is the number of years for which you do the investment, is considered to be compounding formula. Right? Right? So if I just change the formula, and if I just say that if you are saying that you would be paying me 1100 rupees after 1 year, what is the value of this 1100 rupees today? That is equals to 1100 divided by 1 plus R. So that means what I'm doing is I'm using a discounting formula. So what is discounting? Discounting is opposite of compounding. Is it clear? Are you getting clear? So in the childhood we have done the compounding techniques. I'm just reversing that technique and I'm calling it as a discounting technique. So if you're going to give me this money after 2 years, what I will do? I will say 1100 divided by 1 plus R raised to power 2. Because there was an n also in that particular formula. You're getting my point? Are you getting my point? Now, I'll just slightly make it a little difficult. In the last examination, in December 2015 examination, there was a question in, I think, the old syllabus, yes. In the old syllabus, there was a question which was talking about bond valuation, which was principal amount is the discounting value. Now, I'll explain it again. Yeah. So, principal amount is when we talk about discounting value. Now, there is no term called discounting value. You have a discounting rate or discounted amount, right? So, by applying the discounting rate, what you get is the discounted amount. Okay, that I think you're talking about discounted amount here. See, the thing is, what I'm trying to say is, just forget about what we have discussed. If I say that you purchased a bond, it will become more clearer with this technique. Supposing you purchased a bond of rupees 100. And the company said that we will be making a coupon payment of 6% on an annual basis. Fine. You generally get a bond, 100 rupees bond, on which there is a 6% coupon interest on an annual basis. So, and if the life of the bond is say for 5 years, then what are you going to get? You are going to get 6 rupees every year for a period of next 4 years, and in the end of the 5th year, you would be getting 106 rupees because you would be getting your principal amount also back, right? Right? So if you buy a bond where the coupon rate of interest is 6%, what do you get? You get 6 rupees of interest every year. If the life of the bond is for 5 years, you get 6 rupees for every 4 years, and in the 5th year you get 106 rupees. Are you familiar with this? Is it okay what I'm trying to say? Is the point clear? Is the situation clear rather? Okay. Now, if I want to know that what is the present value of this bond, what should be the price of this bond in the market? What should be the price of this bond in the market is equal to the present value of the future cash inflows that I'm going to get. I am going to get 6 rupees after 1 year. Now, if the discounting rate, if my cost of, and how do I discount? In order to discount, in order to discount a particular cash flow, I have to use a discounting rate. This R I have to take. What is this R? How do we calculate this R? This I would be discussing with you when I discuss the chapter on cost of capital. Right now, I will say that R is your cost of capital. The company is paying you 6%, assuming in order to give this 100 rupees to the company, you arrange the funds at 5% rate of interest, or if the market rate of interest or your cost of capital is 5%, right? So what you will do, you will say that, okay, I am going to get 6 rupees after 1 year. So what is the present value of this 6 rupees? That is equals to 6 divided by 1 plus R, right? 6 divided by 1 plus R. Now, if this R is 5%, then it will be equal to 6 divided by 1 plus 0.05. Is it clear? Then in the second year, I am going to get again 6 rupees. The value of those 6 rupees is equals to 6 divided by 1 plus 0.05, which is my R here, raised to power 2. Then in the third year, I am again going to get 6 rupees. The value of this 6 rupees is equals to 6 divided by 1 plus R, which is 0.05, raised to power 3. Again, in the fourth year, I am going to get 6 rupees, which is equals to 6 divided by 1 plus 0.05 raised to power 4. Then in the fifth year, I am going to get 106 rupees. So the value would be equal to 106 divided by 1 plus 0.05 raised to power 5. Is the point getting clear? What am I trying to do? I am trying to find out the present value of this bond when the discounting rate is equals to 5%. Right? So let us do this calculation. Though it is, you would say that, ma'am, how am I going to do this raised to power, raised to power, raised to power? Yes. So what you should do, there in the examination also, and in the end of every book, you have been given a discounting table. And that is there in my PPT as well, which I will just show it to you. So what you should do is, you have to use the discounting table. Now, if I look at this discounting table, it writes table 1, present value of rupee 1. Now, this is applicable for rupee 1. If rupee 1 is discounted at 5% for year 1, so that is equals to 1 divided by 1.05, it is equals to 0.9524, is equals to 0.9524. So my bond's value is going to be equal to, I'll just use my calculator, it will be equals to 6 multiplied by 0.9524, right? Because the present value of 1 rupee at 5% discounting rate is equals to 0.9524. You can even use your calculator and simply do this. 1 divided by 1.05, and the value you will get is 0.95238095, which is equals to 0.9524, because we are not going to that kind of a decimal place, right? Are you getting my point, what I am doing? I have been given a table so that I am not required to do this calculation. Now, if I have to look at what is going to be the value of 1 rupee at 5% at the end of year 2, in that situation, I will again go back to now here we have got year. Now look at here. Here we have got year and this is the rate. So the figure will be 0.9070. Is it getting clear? So 0.9070, then what I do again, I again, just one second. What I will do again, I will again write 6 multiplied by, you can again use your calculator if you want, or you simply can 0.9070, it was the figure, so 0.9070. Then I have again been given, in the third year also I am getting 6 rupees. So 6 multiplied by again what? The figure is 0.8638. So I multiply it with 0.8638. Then in the fourth year, 6 multiplied by, again I'll look at the table, yes, it is like that only, 0.8227. Every year, because you are increasing one level of power, right? So that is why it is 6 divided by 0.9070. How did you get it? 0.9070, okay, that is the second year. In the third year, it is 6 multiplied by, it's divided. No, it's not divided by. It is multiplied by. Just try to understand, Meera. This value of 0.9070, how are you getting it? It is 1 divided by 1.05. Right? So what you are writing it as 6 multiplied by 1 divided by 1.05. Is the point getting clear? Okay? So 0.8638 के बाद we had the figure 8227. So we pick up that figure 0.8227. And then in the last year we have got 106 multiplied by 0.7835. 0.7835. Now you will say that, ma'am, why are you doing this exercise? I am doing this exercise because I want to know the present value of this bond, right? So if the rate of interest for me, or if the cost of capital for me is 5%, so 6 multiplied by 0.9524 is equals to 5.7144 plus. So that means 6 rupees which I am going to get after 1 year is equals to 5.7144 today, right? The 6 rupees which I am going to get after 2 years is equals to 5.442 rupees today. 6 rupees which I am going to get after 3 years is going to be equal to 0.8638, it was 5. Yes, the discounting factor has to be equal to cost of capital. Very right, Ruchika. 5.1828. Very correct. So 3 years, after 3 years, when I get 6 rupees, it would be equal to 5.1828 today. And 6 rupees which I will get after 4 years, it would be equal to 0.8227. So that will be equal to 4.9362 rupees. And in the last year when I am getting 106 rupees, that is equals to 0.7835 for 1, that is equals to 83.051. That is going to be equal to 83.051. So what is the value of this bond today? Because I have discounted all the monies that I am going to get after in these 5 years from this particular bond to the present value. Let me add these present values and that should be the value of this bond, right? So that is coming equal to 5.1828 plus 4.9362. That is coming equal to 104.32. So if you're getting this bond for 104 rupees today, you can say that it is equal to the amount that you're going to get in these years. So the present value of this bond, the market price of this particular bond, can be 104.32, right? So that's how so even if you're getting this bond for 104 rupees today, and if you're getting an interest at the rate of 6% on this particular bond, it would be equal to no profit, no loss situation for you. You're getting my point? You're getting my point? The present value of this bond at 5% cost of capital. But if this is applicable when the cost of capital is 5%. If you increase the cost of capital to 6%, the value of the bond will reduce or it will increase. If I increase the cost of capital, what would be the value of the bond? Will it be more or it will be less? It will reduce. Yes, it will reduce. So at 6%, the value of the bond will be 100 rupees because what you're getting is also 6%. Right? So 6 divided by 1.06 would come to around 100 rupees. If you increase the cost of capital, the value of the bond will reduce, and if I reduce the cost of capital, the value of the bond will increase. You're getting my point? So how am I finding out this present value? I am just discounting the future cash flows. This 6 rupees is your future cash flow, right? This 106 rupees is your future cash flow. This is the amount that you're going to receive in future. This future cash flow has been discounted using a cost of capital to get the present value of that particular bond. Is the point clear? Is the concept of discounting clear? Or do you need some more example or some more understanding of it? Because this is one of the basic concepts of financial management. If this concept is clear, I think half of the job is done. And it's a very simple concept. It's a very, very simple concept. Now there's another way of doing this exercise. I'll just slightly change the method though I would be coming to the same conclusion. I would slightly change the method. I am getting 6 rupees every year for a period of 4 years. And in the last year, I am getting 106 rupees. So that means I am getting an annuity of rupees 6 for 4 years. Right? When you get the same amount every year on an yearly basis, we call it as an annuity. Got my point? When you get the same amount every year, we call it an annuity. So you're getting an annuity of rupees 6 for a period of 4 years. Now, when you look at these tables, in order to make your job easier, there's another table which is available which talks about present value of an annuity of rupee 1. Present value of an annuity of rupee 1. Now, what does that mean? I would be getting 6 rupees for for the next 4 years, and I have to discount at 5%. Right? So the rate is there in front of me, number of years is there in front of me, and the discounting factor, the present value of an annuity of rupee 1 is equals to 3.5460. Now this is the number which is coming in front of me. What should I do? I should say that now what I should do, I should write that for 4 years, because I'm getting 6 rupees, I multiply 6 with the present value of annuity factor at the rate of 5% for the period of 4 years is equals to 3.5460. So 6 multiplied by 3.5460. Okay? Plus I will write 106 multiplied by 0.7835, because that is not an annuity, because here I am getting 106 rupees, which is not 6 rupees, right? So what do I get out of it? I would be getting 6 multiplied by 3.5460 plus, that is coming as 21.276, plus 83.051 plus 83.051, it gives me 104.327. It's the same figure. 104.32 you were getting by discounting 6 rupees every year, or when you get the present value of an annuity factor, you can simply multiply. It reduces your time that you have consumed in order to do the complete calculation, right? So in the examination or in every book, you would be getting two tables. One is present value of rupee 1 and second would be present value of an annuity of rupee 1. So when you are getting the same amount year after year, just use the present value of annuity table. Do not use the present value of rupee 1 because you will have to do a lot of calculations. Is it clear? Is the point clear? Okay. Now, I am not first going to use the discounting technique. I'll first use the cash flow technique and then we will be going for the discounting technique. Okay. I would not be using the accounting profits first of all because I am studying the subject of financial management first of all, and I have already said that accounting techniques, accounting profits or accounting calculations are not very reliable because there can be a lot of ambiguities in this, and it does not consider the time value of money. So in the cash flow technique, I've got two methods. One is undiscounted techniques where I'm not doing this discounting exercise and simply looking at the cash flows. Second is where I use the discounted techniques. So if I am not using the discounting techniques, then I've got only one approach, which is called the payback period method. But when I use a discounting technique, I've got more than one, that is 3-4 methods: the net present value method, the profitability index method, the internal rate of return method. So lots of methods are there, right? So what do? I will first use the undiscounting technique where I would not be doing the discounting, simply using the cash flows. Okay. How do I calculate the cash flows? It is net profit after taxes plus depreciation. Okay. So, and I'm not discounting it as of now. I'm just simply using them as an absolute figure without discounting it. Right. So how do we find out this payback period? See, in a capital budgeting technique, what are we trying to explore? We are trying to find out whether a particular investment will give me the adequate return or not, or whether it is advisable to go for a particular investment or not. Now, whether it is advisable to go for a particular investment or not, that means that in every decision, there would be some cash outflow involved at the beginning, isn't it? Because once I make the investment, then only I would be getting the returns, right? So there would be some project cost involved in each of the capital budgeting decision, and this project cost has to be incurred either at this particular point of time. We call the present as year 0. We call the present as period 0, and then 1 year we call it as year 1, second year we call it as year 2, third year as year 3. So in the year 0, there's going to be some cash outflow, or there can be some cash outflow expected in the earlier year and the returns expected in the later years. So we have to first find out in the payback period method, what we do, we simply try to evaluate how many years it takes to recover the initial cost that I have incurred, the project cost, or how long does it take to get the business's money back. That means that supposing there is a particular investment, a particular situation, which is called franchise L. Franchise L, this means that you are investing in a business called L. L here, for my understanding, I am taking it as long. So I am investing in franchise L, which is called long investment. Here in the first year, CF stands for cash flow, T stands for period, right? Time. So cash flow in time 0. Here in this on this line you've got 0, 1, 2, 3, 4, right? So in the year 0, you are going to pay 100 rupees. There is an investment of 100 rupees. This investment will give you a cash flow of rupees 10 in the first year, a cash flow of rupees 60 in the second year, and a cash flow of rupees 80 in the third year. Right? So if you invest rupees 100 today, you will get a cash flow of rupees 10. Now this is not the accounting profit I'm talking about the cash flow. So this investment will give you a cash flow of rupees 10 in the first year, rupees 60 in the second year, and rupees 80 in the third year. What I do in the payback technique, I simply try to add up these cash flows. So that means what I'm doing is, I'm saying that okay, in year 0 there is a minus 100, right? So what am I getting in year 1? In year 1 I'm getting plus 10. So my cumulative is now minus 90. Okay. In the second year, what am I getting is 60. Yeah. In the second year, I'm getting 60 rupees of cash inflow. So what I do, I write plus 60 here. Right? So this is my, here if I write the period, then, sorry. Yeah. So in year 1, in year 0, you are paying minus 100. Then in year 1, you are getting plus 10. So your cumulative is minus 90 here, right? Now, in the second year, in year 10, what you are getting? You are getting plus 60. So your cumulative has become minus 30. Okay. Then in the year 3, you are getting plus 80. And now your cumulative is coming in positive, that is plus 50. Right. Now, in the payback period method, I want to know that period in which I am able to recover this initial cash outflow of 100 rupees. That period in which I am able to recover this initial cash outflow of 100 rupees. Are you comfortable in Hindi as well, Meera and Diksha? Not much. Okay. So you are investing 100 rupees here, right? And when you are investing 100 rupees, you want to know that in what period I will get my 100 rupees back. Let's not talk about profit. Let's not talk about any kind of a value addition. What is the period in which I'm getting my money back? And I'm not even discounting. Even if I'm getting my money back after 1 year, I'm still counting it as an absolute figure, right? So you say that by the end of second year, you are left with only 30 rupees of investment. So it has to be the payback period would be more than 2 years but less than 3 years. So it would be 2 years plus, how much do you want? You want just 30. 30, and how much are you getting? Divided by 80. So 2 years plus 30 divided by 80. That would be your payback period in this kind of a project. So 2 years plus 30 divided by 80 is equals to 2.375 years. Right? So this is my payback period. Ma'am, could you go over that part again? Okay. Yeah, tell me. Payback period. See, I said that in the first year you are just getting 10 rupees. Right? So you are still to recover 90 rupees. In the second year, you are getting 60 rupees. Now you are still to recover 30 rupees. In the third year, you are getting 80 rupees. You just wanted 30 rupees, but you are getting more. So you just want to know in what period do I get my initial investment back. So what you say, 2 years plus 30 divided by 80. So how much of proportion of the third year will go in recovering these 30 rupees? So it says 2 years plus 0.375 of the third year, right? So 2.375 years. Is it clear, Diksha, now? No, yes, it's clear. Okay, now you would say that how does it make a difference? This will make a difference when you compare it with the cash flows or with the payback period of the other project, right? So you will, because every time whenever I have to do an investment decision, in general I would be having some alternatives in hand. Should I buy this machine or should I buy that machine? Should I invest in X project or should I invest in Y project? So I have seen one particular investment where the cash outflow is 100 rupees and this is the inflow. I compare it with another investment which is called franchise S. In franchise S, again the cash outflow at year 0 is 100 rupees only. In the first year you are getting 70 rupees. In the second year you are getting 50 rupees. And in the third year you are getting 20 rupees. Again you will do the cumulative thing. So minus 100, because in the first year you are getting 70 rupees, so your cumulative is minus 30 here. In the third year you are getting 50 rupees, so your cumulative is plus 20 here. You want to know the period in which you are getting your initial money back. So what you will write? 1 year plus, how much do you want more? You want 30 more. 1 year plus 30 divided by 50. How much are you getting? You are getting 50. So in this particular project, you are getting your money back in 1.6 years. If I go simply by the payback period method, that too undiscounted payback period method, I would simply say that I would like to go for project S. I would like to go for franchise S because here I am getting my money back in 1.6 years. But in franchise L, I am getting my money back in 2.375 years. Shorter the period, the safer I am because I am getting my money back. Shorter the period, I am more safer. I am not taking much of risk. I am getting my money back fastly, and that is why I am interested in taking the franchise S rather than franchise L. I am interested in investing in rather franchise S and not in franchise L. Is the point getting clear? But this particular method, if you look at, it does not make much of sense to us. Because how can we say that after getting your initial investment back, whether that particular project would be profitable or not? And in certain projects, like if you look at various infrastructure kind of projects, initially you do not recover your money back very fast, but once the project starts running, it's really a very good investment. And if I look at this a kind of a method, I would not invest at any point of time in long gestation projects, which is not considered to be the right way, isn't it? Because how can I say, because if I look at the things, in general, here if you look at franchise L, which I have rejected, the cash flows were increasing from 10 to 60 to 80 and it may have increased further. And if I look at franchise S, here the cash flows were consistently reducing. So if I look at from a layman's perspective, you would say that, ma'am, though technically you are saying that franchise S is better investment, but from the layman's point of view, I feel that franchise L would be more profitable, isn't it? You got my point? So this payback period method has got this particular weakness. One, it ignores the cash flows which occur after the payback period, which is a very big weakness. And it is also not discounting the cash flows. It is not even looking at the cost of capital and not even discounting the cash flows. And second, it is ignoring the cash flows occurring after the payback period completely. But still this method is used. Why? Because it is the simplest of all methods. It is very easy to calculate and very easy to understand. And at least it gives you an idea about liquidity. That how soon you would be getting your money back and then you can reinvest that money in some other project. So it gives you that for how long is your money going to be blocked in a particular project. You're getting my point. So this method, though not a very, very dependable method, but still it has been used because it is because of its strengths of easy calculation and it gives you an idea about the liquidity. So the undiscounted payback period method, is it clear to everybody? Any doubts? Any questions? I'm not getting any responses. But then, the people who propounded this payback period method, they said that, okay, if you tell us that we've got two weaknesses, one is that we do not consider the cash flows which are occurring after the payback. Second is that we are not using the time value of money concept. So they said, okay, no issues. Let us use the time value of money concept. Let us discount these cash flows and then find out the payback period. That is also something that we can do. So in the discounted cash flow techniques, they discounted the cash flows. Now, which all techniques are there? It is not only the payback period method which is available in the discounted cash flow techniques. In the discounted cash flow techniques, you've got the net present value method, you've got the internal rate of return method, you've got the profitability index method. So in order to do these methods, first of all, you need to know the cash flows. The expected cash flows, not only the cash flows, but the expected. In future, if I'm going to make this particular investment, in future, what is the return, what is the cash flow that I can expect from this particular investment? So first of all, you have to make an estimate of the expected cash flows, and not only the estimate of the cash flows, but also their timing. So in year 1, what is going to be the cash flow? In year 2, what is going to be the cash flow? In year 3, what is going to be the cash flows? Right? And you also will look at the cash outflows, because there might be certain cash outflows also involved in these years or in the year 0. So you will look at the cash outflows and cash inflows. You will only talk about the cash outflows and inflows. So you will not take into account depreciation, but you would definitely take into consideration the tax effect of depreciation as well. And this is one thing which I would like to make it clear right now over here. When we calculate cash flows, I told you what you do: profit after tax plus depreciation. This gives you the cash inflows, right? Now, you would question me that, ma'am, can't we calculate it like this, that we say gross profit minus all expenses except depreciation minus tax? I would say no, you can't do it like this. Why you can't do it like this? Because depreciation is a tax deductible expense. Because of depreciation, your tax liability gets reduced. How? Supposing you had earnings before interest and taxes, excluding depreciation, of say rupees 100, right? Then you charge depreciation of say rupees 20. So now your earnings before interest and taxes equals to 80 rupees. Right? On this, supposing you do not have any interest and there is a tax rate of 50%, so you will have a tax liability of 40 rupees and your profit after tax would be 40 rupees. Right? Now, if you would not have taken this depreciation, in that situation, what would have happened? Your amount would have been 100. Without depreciation, your earnings before interest and taxes would become 100. And your tax at the rate of 50% would have been 50 rupees. Would have been 50 rupees and your profit after tax would have been 50 rupees. Right? Now here, because you would say that in this situation, because I've not taken the profit, I've taken into account depreciation, so I will now add depreciation to find out the cash inflows. Now it becomes 60 rupees. So what I'm trying to say over here, because I've not reduced depreciation, so I will not add it. This method second method is a wrong method. It's a wrong method. Why? Because I have to first reduce depreciation. Because of depreciation, my tax liability gets reduced. You can see that by charging depreciation, now I'm paying 40 rupees of tax, which without depreciation I was paying 50 rupees. So I will have to first charge depreciation, calculate my tax, and then add back depreciation. Is the point clear? Is the point clear? Why am I adding depreciation after charging taxes? Yes, no, tell me. It's not clear. See, what I'm trying to say is that depreciation is an expense. Depreciation is an expense. So in order to calculate tax liability, what you do, you reduce all tax deductible expenses from your income, and then you calculate the tax liability. But depreciation is a non-cash expense. You do not pay this amount to anybody. So what you do, in order to find out your cash flows, you add back the depreciation which you had earlier charged to your profit after tax. And then you get the cash. Then you get the cash flows, cash inflows. Right? But in case you would not have, because you can say that if I am first reducing depreciation and then I'm adding depreciation, rather than doing these two adjustments, why can't I simply, not take depreciation? If you would not take depreciation, in that situation, your expenses will get reduced, and because your expenses will get reduced, your tax amount will increase. And thereby your all calculation will go wrong. So therefore, you have to first reduce depreciation, calculate your taxes, then find out the profit after tax, and to this profit after tax, you will again add back depreciation to find out the cash inflows. Got it now? Any questions? Because why I'm taking these concepts with you today, because they are the most, they are the concepts based on which you're going to do all your exercises, right? So, and these are the general, problems, these are the general mistakes that every student does, where, he or she may, go for, try for shortcut methods and try to, do the wrong calculations. So, you have to estimate the project's cash inflows. And when we talk about cash inflows, you have to look at the tax effect of depreciation as well. Each method requires an estimate of project's risk. So risk will be measured by your cost of capital. Risk in financial management is always measured by your cost of capital, because what is the question over here. How do we calculate the cost of capital? For that, we would be doing a complete chapter. So that discussion of cost of capital is deferred as of now. Right now, we will assume that, there is a cost of capital or there is a discount rate which is available, which will be given to us, right? So, at times, if we do not have the cash flows, if we cannot estimate the cash flows, or if we cannot estimate the cost of capital, then we cannot use the discounted cash flow techniques. So for using these techniques, we need to have the cash flows and we need to have the discounting factor. They are the two basic requisites that we need to have. So how do we discount cash flows? I've already discussed with you. In order to find out the future value, we have been using the compounding formula, which is equals to principal or present value multiplied by 1 plus r raised to power n. In order to find out the discounted value, what we do the future value divided by 1 plus r raised to power n, and that is what we did in that particular example that I did with you. I'll just give you a snapshot when we discuss the bond case, right? Where was it? Just a second. 106 example that I did. Here, it should be. Let's see. Yeah, this is the example that I had done, where I had used the discounting and the compounding technique with you. So it says that you have to discount the cash flows when you want to do that, when you want to use this methods of net present value. In case of another method that I would be using with you in the capital budgeting decisions, it is called IRR method, internal rate of return method. in that particular method, we will try to find out R, the cost of capital, the risk factor, which we would be trying to find it out while we do this method. We have already discussed about the discounting tables. So now we go to the discounting technique. So far we haven't used the discounting technique, we just use the cash flows. Now we are using the discounted cash flows. So what we are doing, we are saying that same project, we are looking at the example of the S project, the franchise S. We said that you are going to invest ₹100 at year 0. In year 1 you are getting 10 rupees. In year 2 you are getting 60 rupees. It's a cash flows of long project. And in the year 3 you are getting 80 rupees. Right? Now what you need to do, you have to discount these cash flows. You have to discount these cash flows. How are you going to discount it? In order to discount this, you are getting 10 rupees at year 1, right? And you're paying 100 rupees at year 0. Now when we talk about year 0, at the present we cannot discount the present. We have to discount the future, right? So 100 would remain 100. The 10 rupees that you are getting in the first year, it has to be discounted at the discounting rate which has been given to us as 10%. As I said, this rate would be given to you in all capital budgeting questions. So this 10% has been given to us, right? So in year 1, I'm getting 10 rupees. That means 10 divided by 1.1. Because this is in year 1, this is equals to 9.09. 10 divided by 1.1 is equals to 9.09. In the year 2, I'm getting 60. Now this has to be divided by 60 divided by 1.1 raised to power 2. That is equals to 49.5867. That is equals to 49.59. In year 3, I'm getting 80 rupees. Again, I divided by 80 divided by 1.1, then 1.1 and then 1.1, because I have to divide it by 80 divided by 1.1 raised to power 3. This is equals to 60.11. Right? So now I've got the discounted cash flows. Again, the same technique of the payback method I will use. I will find the cumulative cash flows. In year 0, my outflow is 100 rupees. Then in the year 1, I'm getting 9.09. So I reduce 9.09 from 100 rupees and my cumulative cash outflow is right now 90.91. Then I add to it the cash flows that I am getting in year 2, the discounted cash flows that I am getting at year 2. So 49.59 I add to minus 90.91 and my cumulative outflow is minus 41.32. To this I add 60.11 and then I get the cumulative cash outflows of 18.79. Now I want to know my payback period, that to my discounted payback period. It is going to be somewhere between year 2 and year 3. So what I do, 2 years plus how much I want? I want 41.32. And how much am I getting? I am getting 60.11. I just want to know where I would be getting 41.32. So that will come in 2.7 years. Right? In these 2.7 years, I will not only recover my initial investment of ₹100 but also interest cost at the rate of 10%. Not only my initial investment of ₹100 but also interest cost at the rate of 10%. Is the point clear? If I would not have included the interest cost, then I was getting my payback in 2.375 years, right? Because I have now included the 10% rate of interest as well, so I'm getting it in 2.7 years, right? How to calculate 4.32? See, you can use the discounting table which you had seen here. So at 10% for 2 years, this is the annuity factor, sorry. At 10% for 2 years, the rate is coming as 0.8417, right? So if the rate is, if the discounting factor is coming as 0.84 something, so multiply 60 with 0.8437, right? And you will get this figure. Another way of doing it is, another way of doing it is 60 divided by 1.1, you get 54.54. Again divided by 1.1, you get 49.58. Got it, Ruchika? And then is 4.32. Okay, sorry. You wrote 4.32. So 41.32. It is simply 90.91 plus 49.39. Because I'm trying to find out the cumulative. 90.91 minus 90.91 plus 49.59 is equals to minus. Okay? Is it clear? So in this 2.7 years, I am recovering not only my initial investment of 100 rupees, but also interest at the rate of 10%. Okay? And the name of the technique is discounted payback, because I've discounted my cash flows and then calculated the payback period. Okay, ji? Now I go to, so the discounted payback and the undiscounted payback, is it clear completely? Then I go to the next technique. You need to practice the techniques because it's not very difficult, but still, some level of practicing would definitely be required. Very rarely in the examination they ask a question on payback period method. But whenever they ask, they generally ask it along with the other techniques. So you should be familiar with the technique, and it's a very simple technique, and I generally advise everybody to know this technique. Then we go to the next method, undiscounted method illustration. Okay. Here it is. We had not discounted them at 10%. We had simply taken the figures, absolute figures. Here we are discounting them because we want to see the present value of the money that we would be getting after a particular period of time. Right? Definitely by discounting it, our period is going to increase. Yeah, so the next technique that I have to take up is the net present value method. It is the net present value method. Now, as per, so what do we do here? Just one second. This is one of the most important of all the techniques. Invariably asked whenever there is a question on capital budgeting, this technique would definitely be asked, and not again a very difficult technique. In this, what we do, same thing that we have done in the discounted cash flow technique, but here what we will do, we will not stop our discounting at the end of the period where we get the money back, right? We will keep on doing the discounting. Like the example which I had taken up over here, what we did, we discounted all the cash flows which we are going to receive over a period of time. This 6 rupees which I am going to receive in 4 periods, I am going to add them together, and in the 5th year, whatever principal money I am going to get back, that also I am adding. So all the money which I am going to get on a particular project over a period of, over its life, I am going to add it together. You can say that, ma'am, there would be certain projects where we do not know, they can be endless. Like supposing if I buy a house, in that situation, that house is going to remain with me for years to go. And how do I find out the value of the house? Because the rental will come to me over a period of time. So in those situations, definitely, yes, we do go for a technique where we take the terminal value. So we say that the inflows over a period of 6 years, 10 years would be this much. And thereafter, we take a terminal value of that particular project. We would be discussing the concept of terminal value with you in the next class. But right now, we are looking for those projects which are where we can see the end of the project, where the life is given to me as certain. Where I'm not talking about a project which has got an unlimited life. I'm talking about a project which has got a limited life, and I'm able to see the cash flows over that particular period of the project, right? So what I will do, I will do the estimation of all the cash flows throughout the life of that particular project, and then discount all the cash flows, right? And after discounting all the cash flows, whatever present value I get, that similar to 104.32 which you had calculated in this particular example, whatever present value I get, this is the present value of future cash inflows, isn't it? What is this 104.32? I hope you remember this example which I did with you a few minutes from now. So this 104.32 is the present value of future cash inflows. Compare it with the present value of the cash outflow. Supposing you are getting this bond, this 104.327, the present value which you are getting, supposing you are able to get this bond for 102 rupees. If you are able to get this bond for 102 rupees today and the present value of the future cash inflow is 104 rupees, this particular bond is giving you a value of 2 rupees 32 paisa. You're getting my point? That is called net present value. That is called the net present value. So in the net present value technique, what we do, we compare the present value of future cash inflows with the initial investment that I'm going to make, and if the difference between the two is positive, we will say that the net present value is positive and that particular project may be accepted. And if the difference is going to be negative, we will say that this particular project is reducing the value, is destroying the value, and we should not take up that particular project. Is it clear? So you will say that, ma'am, this is not clear. So should we take an example, which I would be doing just now. So what we do, now simply at times when you write the formula, you would say net present value is equals to sigma T0 to N. So what you're going to do, you're going to discount the cash flows over a period of time and then add back those cash flows, and from that you're going to reduce the cash flow at year 0. This is just a formula. Sigma means summation. This particular thing, this is called summation. So you are going to add the cash flows at year 1, year 2, year 3, year 4, year 5. Discount them with 1 plus r raised to power 1, 2, 3, 4, 5. Whatever is the sum, from that you are going to reduce the cash outflow. And if the difference is going to be positive, you are going to accept that project. So difference is called the net present value. The difference between the present value of future cash inflows and the present value of the cash outflow is called the net present value. Right? And how do we get the present value? We get the present value by discounting. For example, supposing there is an investment in which the initial cash outflow is 1 lakh rupees. You're investing 1 lakh rupees in a particular project at year 0, right? The discounting factor is given to you as 10% because you're discounting by 1.1. So the discounting factor is 10%. This particular project is going to give you these cash inflows over a period of time. First year you will get 26,000 rupees. Second year you will get 28,000 rupees. Third year you're getting 31,000 rupees. Fourth year you're getting 33,000 rupees. Fifth year you're getting 36,000 rupees. And sixth year you're getting 18,000 rupees. Assuming the life of this particular project is just 6 years. So you will discount these cash flows. So how do you discount? You multiply this figure, this amount, with the discounting factor, right? So 1 divided by 1.1 is equals to 0.9091. So you multiply 26,000 with 0.9091. So you get 23,637. Next year 28,000 multiplied by 1 divided by 1.1 raised to power 2. So you multiply it with 0.8264. You get a figure of 23,139. Add them all together and then compare it with rupees 1 lakh. When you do the comparison, you find that there is a positive net present value. The difference between the cash inflows and the cash outflow is 25,121. Till the time the net present value is positive, till the time the net present value is going to be positive, we are going to accept a particular project. We are going to accept a particular project. Is the point getting clear? So the technique is not very difficult, and the only thing that now we have to do is, we know how to do the discounting. At times in the question, the cash flows will not be given to you. You will be required to calculate the cash flows. Most of the times in the question, the cash flows would be given to you. For example, if I look at a question that was asked in December 15 examination, I was not able to copy it because I have it in JPG file. So I thought that I will just show it to you. Just a second. Just a second. It was a new syllabus question paper. Yeah. A company, this is question number I don't know. The question number is not very clearly visible. A company has two alternatives for selecting a new machine to replace its existing machine. So company has got an existing machine. Now the company wants to replace the existing machine, right? So the company has got two alternatives. Two particular machines are available. If it invests in machine A, the cash outflow is going to be 25 lakh rupees. And if it invests in machine B, the cash outflow would be 40 lakh rupees. And then the cash inflows have been given to you. Year 1, year 2, year 3, year 4, year 5. All these cash inflows have been given to you in the question itself. You are required to appraise the two alternatives using net present value and profitability index methods, and the cost of capital of the company is 15%, and this is an 8-mark question, right? So do you think that you can do this question now? Simple question. You have been given the cash outflow, you have been given the cash inflow in the two different machines, and you have been told that the discounting factor is going to be 15%. So can you solve this question? What would you do in order to solve this question? Find the net present value. How would you find the net present value? How will you find out the net present value? So if you can do this question, okay, fantastic. You will discount the inflows by 15%. So what I do in this particular class, I give you a homework. This is the question that came in the last examination in the new syllabus. The question paper, I hope, should be available with all of you. If not, I can forward the image on the WhatsApp group. But Meera is not on the WhatsApp group, right? So I will forward the image through email. That's also not a problem. You can simply, you need to solve this question and bring it to me in the next class. So you will mail me the question, mail me the answer once you're through with it, right? But before I do this, I will also be giving you what is profitability index method, which was asked in the question. So I'll just let me finish, because I would not take IRR method today. I would be taking the profitability index method. Just one second. These slides I would be discussing with you in the next class. Okay. Rather than going to the slides, I'll just give you the profitability index method on the whiteboard itself. See what happens. Supposing you've got two projects. In one project, you are investing. In one project, you're investing 100 rupees. And in second project, you are investing, say, 60 rupees. Now, the first project is giving you, assuming the cash inflow of 125 rupees. And the second project is giving you a cash inflow of 75,000 rupees. If I go by the net present, this is the cash inflow, this is the present value of the cash inflows. So if I go by the net present value method, then in this situation, project A is giving me the net present value of 25 rupees and project B is giving me a net present value of 15 rupees, isn't it? Project A is giving me the net present value of 25 rupees and project B is giving me a net present value of 15 rupees. Which of the two projects would you like to invest in? Which of the two projects would you like to invest in? If I go by the net present value method, you would like to invest in project A. But because the two projects have got different levels of investment, I think just looking at the NPV method would not be the right, thing to do. We should look at it also from the profitability index method. So what do we do in the profitability index method? In the profitability index method, we say, we'll take the formula, present value of cash inflows divided by present value of cash outflows. So if I look at the profitability index, in that situation, the profitability index of project A would be 125 divided by 100 is equals to 1.25. And the profitability index of project B would be 75 divided by 60. So that would be equal to how much? 1.25 again. Oh my God. Now this is becoming difficult. But if, look, okay, because I just took an assumption. So if I take it to be 80 rupees, I think that will be still, right now the project A is more attractive. So if I take it as 80 rupees, in that situation, my profitability index in case of B project would not be 1.25, it would be 1.33. Right? So now I say that though by the net present value method, my net present value is more in case of project A. But if I look at the profitability index method, project B is giving me a better index because higher the profitability index, better it is. By investing 60 rupees in the project, I am able to earn 80, I'm getting a present value of cash inflows of 80 rupees, whereas by investing 100 rupees, I'm getting a present value of future cash inflows of 125. My profitability index is higher in case of B project and I would like to go for B project rather than A project. So in general, whenever I have to look at the two alternatives where the cash outflows are not same, it is advisable to look at the two projects from two different methods. One is the net present value method and second is the profitability index method. Because unless we compare the two methods, we would not be able to come to a logical conclusion. You're getting my point? You're getting my point? So now you would be doing, as a part of your homework, you would be doing that question which was asked in the new syllabus, this time in the examination, sending the solution to me, and then I will be telling you the right answers in the next class. Right? So, and in the next class, I would be discussing with you the IRR method. I would be doing some practical questions on capital budgeting with you, and that would be the agenda. And I would also give you some, some areas of risks and capital budgeting decision also in the next class. But right now, we'll close the discussion here only, and I meet you in the next class. That would be on coming Thursday, right? So you've got just one day to do your homework, and I hope you will be doing it very well. So till then, we close the discussion for today. Anything that you want to say, any questions, any doubts, any suggestions that you want to give, you're most welcome. Ma'am, do we have to mail you the answer? Yeah, it will be a good thing if you can mail me the answer. Because how would I come to know otherwise? You can keep it with yourself if you want me to solve this question in the next class. But the question is very, very simple, and I think you can do it yourself. So I don't think so that we should spend time of the class in solving the answer. So ideally, you should do it yourself. I was saying about a question in old syllabus and she blocked me with a doubt. No, I had picked up that question. I was talking about a question on bond valuation that was asked in the old syllabus. And I told you how do we do the valuation of bonds. Right? So I had answered that question. In the old syllabus, you can see there is a question. Yes, of course, I can mail you that particular question paper as well. In the old syllabus, there was a question on bond valuation also. You can do that question also. I think that will be a wonderful thing to do. So now you've got two questions to be done in the homework. One is on bond valuation. Don't do the duration analysis of that question because that I would be doing with you separately. But the first part of that question is bond valuation. So you have to do that particular question and you have to do the question in the new syllabus, right? So with this, we close the discussion for today. Now it's good that you've got a better homework than what I was thinking. And to keep you engaged, I think that's the right thing to do. So till then, till the next class, we hold the discussion and, we continue forward in the next class. Till then, bye-bye, good night, and take care of yourselves.